Welcome to Alpha Insights. I'm Jeff. Today we're unpacking a short stack of finance headlines that matter to investors: retirement risk, credit signals, and chasing yield abroad. With me is Marcus, market historian and guide through these knots. Marcus, great to have you.
Thanks, Jeff. Good to be here. These three themes really tie together: how people save and spend in retirement, what credit markets are whispering about risk, and where yield seekers are looking outside the United States.
Let's start with target date funds. I keep hearing glide path and one size fits all. Break that down for folks who might have a default fund at work.
Sure, a target date fund is designed to change its mix of stocks and bonds as you near a chosen retirement year. The glide path is how that mix shifts over time. The problem for many baby boomers is the glide path assumes a generic retirement need. In practice, people retire at different ages, have different incomes, and some need more cash flow right away. That means a default target date fund can leave you with too much equity risk when you need stability, or too little income when you need withdrawals.
So what should someone do if they're in one of these funds?
First, don't ignore it. Log into your retirement plan, find the glide path for your target date series, and check your current allocation. Ask whether there are managed income options or annuity windows. Small percentage changes in equity exposure can matter a lot when you're drawing down. If you need cash flow, tilt toward income-producing assets and keep an emergency buffer. If you want professional help, consider a managed account or advice from your plan provider.
Got it. Next, junk bond yields. I love the phrase canary in the coal mine. Why are high yield spreads important for stock investors?
High yield, or junk, bonds price the risk of companies that carry more debt. Because bond markets react to credit stress faster than equity markets sometimes do, rising yields on these bonds and wider spreads versus treasury bonds often signal trouble ahead for risky assets. Think of it as credit markets shouting before equities start to whisper. For investors, that means watch spreads and flows into large, high-yield ETFs and consider whether your portfolio is positioned to tolerate a credit-driven sell-off.
Any concrete steps there?
Yes, track the high-yield spread versus treasuries and watch flows into big high-yield ETFs such as the iShares iBox High Yield ETF and the SPDR Bloomberg High Yield Bond ETF. If spreads widen sharply, consider trimming duration, reducing speculative credit exposure, or using cash and hedges to buy on the dip. The key is having a plan ahead of the move, not reacting when markets are already volatile.
And the third theme, looking for yield outside the US. The piece highlighted DWX and similar funds. What's the attraction and the catch?
Foreign markets can offer higher coupons and dividends than comparable U.S. instruments right now, and that's tempting. An international yield ETF can boost income and add diversification, but you pick up currency risk, political and regulatory risk, and sometimes liquidity risk. So you have to weigh total return, not just the headline yield, and decide whether to use a hedged or unhedged product. Also watch flows into those funds. If lots of money pours in, yields can compress.
Practical advice for someone considering an international yield ETF.
Compare yields after fees, check whether dividends are covered by fundamentals, understand tax implications in your jurisdiction, and decide if you want currency hedging. Start small, treat it as yield diversification rather than a replacement for core fixed income, and be ready for more volatility than a plain domestic bond fund.
One other thread in the stories was Social Security paperwork errors. Real people are still running into missing earnings. How bad can that be?
It can be material. Missing years or incorrect earnings reduce your lifetime benefit calculation. We saw a MarketWatch case where someone in their late 60s discovered teenage work wasn't on the record after claiming benefits. The fix can change your benefit amount and sometimes requires documenting old pay stubs or employer records. The action is simple. Create a My Social Security account on the Social Security Administration website. Review your earnings statement now and file corrections while you can.
Before we wrap, what are the main catalysts listeners should monitor this week and beyond?
Watch high-yield spreads and flows into major high-yield ETFs for early signs of credit stress. Review your retirement plan glide path and whether your default still matches your needs. Monitor inflows into international yield ETFs as a gauge of crowding and potential yield compression. Verify your Social Security earnings record. And keep an eye on Federal Reserve commentary. Surprise rate moves can tighten credit and lift junk yields fast.
Great. Marcus, give our listeners 2 or 3 quick takeaways they can act on today.
Absolutely. 1. Review your target date fund allocation and ask whether it fits your retirement timeline and income needs. 2. Monitor high-yield spreads and have a defensive plan if spreads widen sharply. 3. If you chase yield internationally, price in currency and political risks and start small.
Solid advice. Thanks, Marcus. That's Alpha Insights for today. Stay curious, keep checking the fine print, and rebalance with a plan. I'm Jeff. See you next time.